Good morning, ladies and gentlemen, and welcome to the Palace Capital PLC half-year results investor presentation. Throughout this presentation, investors will be in listen-only mode. Questions are encouraged, can be submitted at any time. Just simply use the Q&A tab on the right-hand corner of your screen, type in your question and press send. The company may not be in a position to answer every question it receives during today's meeting. However, the company will review all questions submitted today and publish responses where it's appropriate to do so. These will be available via your Investor Meet Company dashboard, and we will send you an email when they're ready for your review. I'd also like to remind you that this presentation is being recorded. Before we begin, we'd like to submit the following poll, and if you would give that your kind attention, I'm sure the company would be most grateful. And I'd now like to hand over to Richard Starr, Executive Director, Matthew Simpson, CFO, and Neil Sinclair, CEO from Palace Capital. Good morning to you all.
So good morning, everybody. Well, thank you for attending this webinar. Just to say that Palace Capital have had a very strong first 6 months. We've successfully negotiated the pandemic. You've all got a copy of the presentation. Looking at the front, the highlights for us are positive sales at Hudson Quarter, York, our flagship development near York Station, and very strong rent collection, which has enabled us to increase the dividend. So we've actually sold 64 apartments. 62 are now completed. 2 are completing tomorrow, making 64 altogether for a total of £21 million, with 8 under offer to the value of £3 million. We also announced in the summer we were embarking on a disposal program of non-core property in order to reinvest those monies in better quality assets. We announced that we were going to sell £30 million worth of property. We sold 12 million by the end of the half year at 5% above book value, and a further 6.9 million has been exchanged since that time. So we're at 18.9 million, and we have 8 million under offer at the moment. Hopefully they'll be exchanged before the Christmas break, so we'll be going very close to 30 million. 90% of our rents due for the September quarter have been collected, a higher proportion than last year, and we expect this to increase to 95% when monthly payments for December are received. So that you understand, most tenants pay quarterly, but because of the pandemic, we agreed that some of them could pay us monthly for cash flow reasons. We have reduced our LTV, loan to value, to 36% as at the 30th of September. This is a level at which we are comfortable. This is because we have sold most of the apartments at Hudson Quarter, and our development facility from Barclays Bank has been reduced to 1.6 million. The exchanges and completions will enable us to repay that money by the end of this month, well ahead of schedule. You will know that we've increased the interim dividend by 8.3% to 3.25p. It is very important it's fully cash covered, which it is, and that is the minimum quarterly level going forward. 98% of our portfolio is compliant with energy performance certificates for 2023 regulations, which Richard will talk about a little bit later. There have been 29 lease events in the first 6 months of the year, providing an additional income of £600,000 per annum at 3% premium to our estimated rental value. So this is our flagship development at Hudson Quarter, York, and at this point we'd like to show you a very short video which gives you an illustration of the quality of the scheme. Thank you. We're very proud of this development. We've won 2 awards in Yorkshire, the Yorkshire Property Awards and the Insider Property Awards. It's our flagship scheme. You can see from that the quality of the scheme. You can see the courtyard there, which is like a back garden in the middle of York to all our residents there. It's gone down very well. 64 apartments, I told you, have been sold, and including the ones under offer, that is £24 million. And we estimate that we make an IRR of 15% on this scheme. As I said, the development loan is being repaid by the end of the month, and Richard will talk shortly when we come on to the office building. This building comprises 3 residential blocks and 1 office block. And because of York's railway heritage, we've named each block after a station. One's called Victoria, one's called King's after King's Cross, and one's called Waverley, which is Edinburgh Waverley. Then we go to our disposal strategy. We've told you that we're selling £30 million worth of buildings. What we've sold so far will enable us to reinvest £6.4 million of equity. We expect to generate a further £10 million altogether for reinvestment once this disposal programme is completed. As I said, post half year, we've sold a further 3 properties for £6.9 million, and these monies will be used to purchase an additional property in order to make sure that we do not lose any income.
So ESG is forming an intrinsic part of our strategy for our existing portfolio and going forward. And we've incorporated all aspects of this into our portfolio. From the E perspective, which is the environmental, the EPC targets are changing quite dramatically. And as we've kind of stated already, by March 2023, you will not be able to let a property if it has an F or a G rating. And that is increasing to a C rating in 2027 and a B rating in 2030. And what we've been doing during the course of the financial year is we've removed all of those F and G ratings, so that as at half year, only 2% of the portfolio is rated below an E. And we will have much more information that we'll be able to give at our full year results in June of next year. The S relates to social, and we're very charitable. We give money to young children and homelessness charities and supporting those. We have done for a number of years. We also carry out a biannual tenant survey, which is currently underway, and we're reporting in the financial annual report the results of that. From the G perspective, which is the governance, we've got an ESG committee in place. The whole board and all of the team are very much involved in it. The TCFD work stream, which is the Task Force for Climate Change Financial Disclosures, again, we're collecting that data, and we will have a lot more information that we'll be providing in our full year results. In terms of the impact of EPCs on debt, Matt's got something to say about that.
Yeah, I mean, speaking to our lenders, ESG criteria has become utmost important in terms of bank debt. Having spoken to our lenders over recent weeks and months, the EPC ratings in our portfolio are absolutely crucial. They're having a look at, we put typically 5 years debt in place. And as Rich mentioned, by 2027, it's got to be C EPC rating, and 2030 a B rating. So if in 5 years, any of our properties don't meet those criteria, the potential is that could be unlettable space. So they want to see how much we have to spend in terms of capital expenditure to get any of our buildings to those criteria. But as Rich will touch on later, we've got a disposal program which is looking at disposing of those particular assets that may not make those EPC ratings or not viable from a accretive value for our portfolio. I think that the long-term future will be that the advent of green loans and green mortgages will be that you start getting better rates on your debt if you're EPC compliant at the A and B level.
So recovering the share value for investors, we're very, very conscious of our discount to net asset value. It's on our agenda at every board meeting. The whole purpose is to close that gap. There's certain things that we can do to do that. One is to increase the earnings, and secondly is to sell the apartments at Hudson Quarter. You can see on the left how we've done so far and what our target is in terms of completing the sales of Hudson Quarter. As you know, we've just said we've sold or got under offer 24 million of apartments at Hudson Quarter, and the value of the remaining apartments is 28 million. We're then targeting the letting of the office building. We've got a 34,000-foot office building called HQ. We state there that we've got 11,280 feet under offer, and Richard will mention in a minute, we've just agreed to let some further space at HQ. So slowly but surely it is letting and people are returning to the office. This disposal program, we received 30 million, including sales and under offer, we're around 26. So we're not very far off completing that by the end of the financial year. Now, people can do the maths. We sell 28 million pound of apartments. It's all our money. We have no bank debt to repay. So with that being reinvested and gearing at 50%, we would increase our income by 3 million pounds per annum over the next 18 months to 2 years. As far as our progress in the first half of the year is concerned, we have already agreed to buy a property for circa 10 million pounds, and Richard will talk about that a little later.
Thanks, Neil. I'll just talk you through some of the key financial highlights of the year. As you can see from the metrics on the slide, it's been a very positive 6 months for the company as we come out of COVID and we start to execute our strategy. It's a return to profit. As you can see, there's an IFRS profit of £8 million and a basic EPS of 17.4p. That's an increase of over 200% for a similar period this time last year. The growth in our EPRA NAV and dividends resulted in a 5.2% total accounting return. We've made significant progress on our net LTV. We've paid back 18.8 million of the Hudson Quarter development loan, which we expect to be fully repaid by the end of this month, reducing from 42% LTV to 36%, and our net debt coming down 21% to 93 million. These positive financials have resulted in the board making the decision to increase our interim dividend to 3.25p, which is an 8% increase. Just having a look at the rent collections, we have maintained a very strong rent collection for the 6 months, which is a continuation of the strong rent collection we had during the COVID period. This is testament to the hard work of our asset management team, the relationships they've built with the tenants, where they've worked tirelessly on every single tenant during the last 18 months and beyond. This has resulted in 100% of the rents being secured from the top 20 tenants, which makes up 43% of our rent roll. Again, we've only given away £100,000 of rent concessions for the 6 months. You compare that to 600,000 for the similar half year last year and 1.1 million for the entire last year. Again, as Neil mentioned earlier, that's given us a cash cover dividend for the full year. Just looking on this next slide, this slide will just give us a reconciliation between adjusted profit on the left-hand side, is what we use for recurring earnings, to our IFRS profit on the right-hand side, which, as you can see, I mentioned earlier, is 200% up at £8 million. This has been driven mainly by the trading profit, realised trading profit on Hudson Quarter sales of 2.8 million. Also, a return to a fair value revaluation gain on our investment properties, and profits on our sale of the 3 non-core commercial assets in the 6-month period. The next slide just gives you, again, a bridge between where our EPRA NAV was at 31st of March at £3.50, just under £3.50, to now, which is £3.62. Again, as you can see there, that's driven by the profit on disposal of the Hudson Quarter sales, the fair value revaluation of our properties, and a small increase in profit on disposal of our non-core assets. Just finally, to wrap up on the financials, just an overview of our capital structure. We have debt in place on the majority of the high street clearing banks. We gear up at conservative levels. As touched on before, we've managed to reduce our LTV from 42% to 36%. This again, 42% was at the year end due to the development loan, which was always going to be a temporary increase. We've now paid 18.8 million and expect that to be fully repaid by the year end. And on that, the covenants, we've remained compliant on every one of our debt facilities within the period. We've got significant headroom due to strong rent collection and repayment of arrears and payment plans during the 6-month period.
Thank you very much, Matt. So just providing on page 15 an overview of where our portfolio is, and you can see the sector splits. Just picking up on a couple of points here, we've obviously let some space during the course of the year, and I'll touch on that in a bit more detail going forward, but our net initial yield has increased over that period of time. And by having let vacant space, the like-for-like ERV of that metric has come down. You can see between March 21 and September 21 has come down to now 12.1%. We've stated previously that we're focusing on offices and industrial sectors, and you can see where that sector split is from the beginning of the financial year and where we're trying to get to. And that 70% is based on the fact that if we sell all the residential units and complete the disposal programme without buying any other properties, that is where we'll be at by the financial year end. This is a chart which shows the valuation changes during the course of the half year. And the two red blocks look like we've lost money, but hopefully it doesn't quite work like that. The £14 million relates to residential sales paying off the Barclays loan, and the 9.9 is the book value of the sales that we've already completed. But as Matt stated earlier, that was the book value, not the sale price, and we've booked a £400,000 profit on those sales. On page 17, we break down what we've done during the course of the financial year so far. So 29 lease events adding £600,000, and it's quite evenly spread between new leases, lease renewals and rent reviews, but significantly all of them are ahead of ERV. Post the half year announcement, we've completed a further 8 lease events, which increases the annual income by a further £200,000, and we've got further to go during the course of this calendar financial year. So what is the impact of letting vacant space? Well, you can see where the contracted rent is as at the 30th of September and where the ERV is, and the majority of that bridge comes from letting vacant space, including Hudson Quarter, which we've broken out. So of the office space in Hudson Quarter, there were 39,000 square feet at the beginning, and we pre-let 4,500 square feet to Knights. But as we've announced, we've got 11,500 square feet under offer, and significantly yesterday we agreed a further letting of about 3,500 square feet. So by the end of the financial year, we expect to have let over half of the Hudson Quarter office space. The other vacant space of 2.3 million, £1 million of that is made up of Newcastle and Manchester vacancy. And we've done very well during the course of the year letting up the vacant leisure assets. And that has led us to only having £360,000 worth of rental to be gained by letting the remainder of the leisure and the retail assets. So we're making significant strides towards being able to bridge the gap between our contracted rent and what the ERV is. We've stated previously that we're focusing on the offices and industrial market, and this is just some information as to where that's coming from. We've returned to the office pretty much full time, and we're expecting that sentiment to continue throughout the whole of the regions, and that working from home is more of a complement rather than a replacement to the office. Why is that? Well, it's mainly because collaborating over Zoom isn't as easy and as profitable as it is face-to-face. And that's being proved by Amundsen Young reporting the Q3 uptake in the big 9 office locations across the country that take-up has been the best in the last couple of years. And that's being driven by large corporate occupiers in the main taking brand new quality buildings. And the reason for them doing that is them focusing on their ESG agenda, which is something that we relate to very clearly in our portfolio. And we expect that to continue in the short to medium term. On the industrial side of things, there is still a lot of value to be gained on the e-commerce distribution sector. And we've all got used to receiving products within an hour now. We used to be 3 or 4 days, now we want things immediately. And that trend is continuing, and the demand from customers is increasing the increasing the amount of demand that is coming from distributors across the country. And we see that continuing. We've stated that we're going to have equity that we want to reinvest. And what we're trying to show here is where that money is going to be going. So on the left-hand side, the objectives are to recycle the money that we have lost from the disposal programme, but also equity that we're gaining from the future sales of residential. We're focusing on the offices and industrial, but historically we've had too much emphasis on development and value add and not enough on that core income. And through Hudson Quarter, we're now obviously going to see the benefits of that. But we want to try and realign the portfolio to a much more core portfolio, not losing our entrepreneurial spirit of having value add and development opportunities coming through. And that will focus our attentions on buying £5 to £20 million assets, focusing the office and industrial, obviously still keeping on with the university towns and city centres with an ESG focus, but more importantly, crystallising the profits of our business plans for each property. As Neil stated, we have agreed to buy a property, and this is an example of what we are looking to buy. We've provided both one for offices and industrial, both around the £10 million mark. And what is the impact on our company of buying these properties? We'll increase our net income by between 4 and 4.5%. Our occupancy stats will go up, and our LTV will also go up slightly, but as Matt has already stated, it will stay within the parameters that we've set ourselves of mid 30%. And our admin cost ratio obviously will also decrease, and our sector focus will also be more, again, focused on more offices and industrial. And we expect to complete one of these purchases during the course of the calendar year, which means that by the lease events that we've already carried out and buying one of these properties, we will have replaced all the income that will be lost through the whole disposal programme during the course of this financial year. That's earnings increative going forward.
So the outlook is that in the summer, we stated in our annual results what we were going to do, and we are delivering on what we are doing in terms of our disposal programme and in respect of Hudson Quarter. The disposal strategy will continue. We're already earmarking certain properties next year for sale. That's one thing. Hudson Quarter, obviously, we're focusing on that. We've got 55 apartments let. We've got interest in them. We are confident that all of those will be sold no later than the end of the next financial year. So you see the estimated rental value to be captured through letting a vacant space. That is a top priority for us. 2 reasons. 1, you get the rent, and 2, you don't pay empty rates. So you actually get a double whammy when you let space. So further sales from Hudson Quarter, which will generate equity for reinvestment. We estimate we'll have over £50 million of firepower for future acquisitions to grow earnings by March 2023 by about £3 million per annum. So we are very confident about the future. We've come out of this in this pandemic in good shape. Not many of our peer group have got the opportunity of reinvesting monies from sales, because normally they've got to pay the banks back. But in terms of Hudson Quarter, we would have paid the bank back, and all the money that comes from that will go into future acquisitions and therefore increase our earnings. So we're very confident about the year going forward. Top priority is to close our discount, and doing what we said we're going to do, we think we'll go a long way to doing that. Thank you.
That's great. Neil, Matthew, Richard, thank you so much for updating investors this morning. Ladies and gentlemen, please do continue to submit your questions using the Q&A tab on the right-hand corner of your screen. But just while the company take a few moments to review those investor questions submitted already, I'd like to remind you that a recording of this presentation, along with a copy of the slides and the published Q&A, can be accessed via your Investor Meet Company dashboard. I'd also like to remind you that your feedback is important to the company, and immediately after this presentation has ended, we'll redirect you for the opportunity to provide feedback in order that the company can really better understand your views and expectations. Neil, Richard, Matthew, sorry, I haven't given you a lot of time to look at the Q&A that's come in, but perhaps if I could hand back to you to read out the questions and give a response where it's appropriate to do so, and then I'll pick up from you at the end.
So the first question, have you seen any improvement in the availability of assets for sale that meet your investment criteria?
So, just leave it on that.
Apologies.
That's okay. So yes, we have seen an improvement in the availability of assets, as improved by the fact that we've agreed to buy something. The investment market is very strong at the moment, and we're very proud of the fact we've been able to make very good progress on our disposal strategy, and that's enabling us to be more in the market and be receiving more opportunities to buy. In terms of expanding on that, obviously we're focusing on offices and industrial, and that's really where the key part for us is.
I think the important thing to know is, because there's so much money around, we're selling our buildings. We're selling into a very good market for sales, which is why our sales are above book value. Consequently, not that easy to buy, but we've got a really good network, and we're confident of securing the appropriate acquisitions. Next question. Is the target to sell 80 Hudson Court apartments in York by the end of this year? No, we've got 55 apartments left to sell, and we anticipate they will be sold by the end of the next financial year, March 23. We hope it will be earlier, but you need to bear in mind that when you agree a sale, they're taking an average of 2 to 3 months to go through. If they need a mortgage, that takes time. And also lawyers appear to be overworked at the moment. So transactions to sell the apartments are taking 2 to 3 months, but we anticipate they'll all be sold by the end of the next financial year. You previously talked about the potential for selling the remaining residential units at Hudson Quarter to an institutional buyer. Can you provide an update on this, please? We did have interest early in the year from 1 or 2 people that wanted to buy a block of apartments. It wasn't in our interest. They wanted heavily discounted. They didn't want all of them, which meant we would have been in competition with them, and we didn't see any point. We were coming out of lockdown. We were confident that within 6 to 9 months we would sell enough apartments to be able to repay Barclays, and that in fact is what's occurred. Where are you seeing the best opportunities?
Well, being a focus on offices and industrial, those opportunities we're seeing a lot of opportunities, but actually we're really quite specific about what we want to buy. So it's focusing on the office market in university towns and city centres. That's really where we're seeing growth, and it's coming from those locations where infrastructure is being input. So that's what we're focusing on, the top 9 cities in the country, unless there's a specific reason to be investing anywhere else.
Where was the divestment in Circle property for 3.2 million capital redeployed? That is going into the pot and is forming part of the cash being paid for this acquisition of £10 million, to which Richard referred. Next question. Hold on, pardon me. Great progress, well done. Would you look to create your own WeWork style offering at Hudson Quarter, given the great location? Perhaps that may appeal to smaller businesses.
So I think in Hudson Quarter the answer is no. We've managed to agree, as we've said, a couple of lettings there, which means we won't need to do that. But what we are doing in other buildings in Manchester, Southampton, and probably maybe also in Newcastle as well, and in Leeds we've done it, is we've actually created smaller suites, fitted them out with furniture, and we're providing that flexible lease term for potential tenants. We've always stated that our office needs to be connectable, adaptable and flexible. And we've put connectivity into all of our buildings so that new tenants can come in and plug and play effectively really quickly without having a huge amount of distraction to their businesses. The flexibility comes in the lease term. The adaptability comes in being able to make space in different ways, because I think people are, as a result of COVID and the working from home, probably looking at different ways in which they can work in their space. So by creating that space already in our buildings, we think we'll be able to attract tenants, and we have been successful in agreeing leases in both Leeds and Manchester to date.
Could you give an update on the search for the new chairman? Yes, we can. We appointed a recruitment company in the summer who we used before to recruit 2 of our non-execs. We have a short list at the moment. We're down to 2 people. We're interviewing them again at the moment, and we expect to make a decision on this within the course of the next 2 or 3 weeks.
How will an increase in the interest rate affect the company? I mean, good question. I think it's a prominent at the moment in terms of where inflation's heading. I think the view is inflation will hit 5% come April next year. I think for us, we analyse things on an ongoing basis. We have over 50% of our debt fixed. We're refinancing a Santander loan that's up for maturity in August next year, which we are already agreed terms at competitive levels. I think really from the Bank of England, we're expecting modest rises in interest rates over the next year. It's not going to go to pre-GFC levels of interest rates, but I think what we can expect is a lot of the inflationary rises are temporary in nature, but we'll see where wage inflation will go over the next few months, the ending of the furlough, but it's something we will look at all level on a continual basis and address that where we see fit.
Next one, Matt. What is the view on Evergrande, and will it spill over to the UK? I don't think so. Evergrande has debt of $300 billion or sterling, whatever the case may be. It's huge. I don't think there's anything comparable that I can think of in the UK. You then say, have your time frame in mind for the exiting of the leisure sector, please. The position there is very clear. We've done some good letting in our leisure. Obviously, a year ago, it was all looking not very good. But at Halifax, we're 97% let, and Northampton, we're 95% let. They are very strong cash flows. We have very good tenants in them. We intend to exit them, but we don't think the timing is right at the moment. We see an improvement coming in that sector, and when it's improved to a level at which we're happy, then we'll consider exiting. But we do expect to do so within the next 2 years.
I think it's worth adding to that that obviously they do produce together over £3 million of our annual income, and we need to make sure that when we do exit them, we have something worth buying, because otherwise we might put ourselves under a bit of pressure with that covered dividend.
Can you expand a little more on office demand in the regions? What has happened to rents, for example, HQ? Richard will speak about this in a minute, but what we've definitely noticed, which we weren't seeing even a month ago, is some of the old inquiries around that people were kicking down the road. I think some of them realise that unless they make a decision about space, they'll be too late. And in fact, the space we agreed to let last night in York, there were 2 companies after it. We haven't seen that for 2 years. We know that's happening in London as well. So there's a definite return to the office. We're very confident about the regional office. Obviously, we've got the government's levelling up agenda. There's loads of attractions for the regions. Bear in mind that 10 years ago, graduates went to London to get a job. That's no longer the case. Graduate retention in the major cities around the country is high. In consequence, we expect regional demand to be very good, and supply has fallen because so many buildings have been converted to residential. Any further comment? No? No. Will dividend payments get back to 2019 level? And if so, what is the timescale?
Yeah, I think the intention of the company and the board will be to grow the dividend payments in line with a sustainable level, in line as we grow the income. So as we've talked about before, it's recycling those disposal proceeds from the commercial properties and the sales of HQ into accretive investments. And our intention will be fully to grow that dividend in line as we reinvest.
At HQ, are the buyers mainly owner-occupiers or buy-to-lets? Are the more expensive properties selling well and are asking prices being met? So it's a bit of both, really. We've had a lot of owner-occupiers. We mentioned in our statement that we've sold 2 apartments, one for 1.05 million and one for 1.2 million. The reason we stated that is that 2 years ago, we took a number of fund managers to York and Newcastle, and some of them were really surprised that you could get these sort of prices in north of England. So we thought it was quite important we should mention it. They are selling well. Both of those apartments were both bought by occupiers. In terms of investors, what is happening there is the rental market is very strong in York. Generally speaking, people who have bought apartments in Hudson Quarter have let them within 24 hours. So we're finding some people are buying their second or third apartment in Hudson Quarter because they're getting more rent than they thought they might get. In terms of asking prices, we are getting within 1% of what we've been seeking from the beginning. Have you made any progress in reducing corporate admin costs? We have. I know Matt's sitting here, but our FD left us at the end of last month, who's not being replaced. So in consequence, that automatically reduces our costs. The percentage of our admin cost was higher than we would like, mainly because Hudson Quarter at that time wasn't producing anything. But if we increase our earnings by, as we said, 3 million a year from the sale of the apartments, then of course the percentage relating to admin costs will reduce. As we reach near the end of Hudson Quarter, are encouraged or otherwise to try and repeat the exercise. We think it was we still think it was the right thing to do. Some people say we should have sold the site when we got planning consent. We didn't think so, because we think that we're going to make more money by developing it. And that is actually what we're doing, because we're going to reinvest the money. There's no one else in our peer group who's got 28 million coming forward in cash to reinvest without doing an equity raise. So would we repeat it? We would just look at it at the time, but we have no development in mind for the properties we've got for probably 2 or 3 years yet.
That's great, Neil. I might just jump in, seeing as you've answered every single question submitted by investors today. So firstly, thank you to everybody that's taken the time to submit questions this morning. Neil, if any more questions do come in, obviously we'll make these available to you after today's meeting. I know investor feedback is important to the company, and I'll shortly redirect investors to provide you with their thoughts and expectations. But perhaps before doing so, Neil, I could just ask you for a few closing comments to wrap up.
Yes, so just say firstly, thank you all for attending this meeting. Just to say that the management team and the board are very confident about the future. We're delivering on what we said we'd do. Our priority is to close the discount to our NAV, and the reason for that, it will enable us to start looking again at corporate acquisitions. That is our USP. Very early on in our development, we bought a subsidiary of Quintain. We bought several corporate entities. That's what we like doing. Using our shares. We can't do that at the moment because of the price, but we think we will close the gap. And when we close the gap, we'll be able to do so. We're also looking to increase the dividend. Once we sell all the apartments at Hudson Quarter and increase the income by, as we say, 3 million a year, that will enable us to increase the dividend. So we are very confident about the future. We've negotiated the pandemic. We've come out the other side, and we're looking forward to the next 12 months. Thank you.
That's great. Neil, Richard, Matthew, thank you so much for updating investors this morning. Could I please ask investors not to close this session, as we'll now automatically redirect you for the opportunity to provide your feedback in order that the management team can better understand your views and expectations. It will only take a few moments to complete, but I'm sure will be greatly valued by the company. On behalf of the management team of Palace Capital PLC, we'd like to thank you for attending today's presentation. That now concludes today's session, and good morning to you all.